The Australian Financial Review.
Hello, I'm Anthony MacDonald, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, for the first time ever, she's the AFR's prodigal reporter, the woman who literally co-wrote the book on Macquarie Group. It's Joyce Malakis. How are you, Joyce?
I'm well, Anthony. I do sound like a bit of a banking nerd, but I suppose I am.
Well, this week we look at what happens when you shake up the RBA, we sink our teeth into Joyce's favourite ASX-listed company, Macquarie, and we catch up on the latest from Donald Trump, and there's a bit to catch up on. But first, Joyce, it's great to have you on the Chanticleer podcast. You returned to the AFR at the start of this year. You're an associate editor at the paper, which I think is probably the best title going around. You're a banking and financial services specialist, been covering that sector for 20 years or more. Tell us, what is it about banks and bank execs that's got you hooked?
Well, yeah, I suppose it's the banks are a dominant part of the ASX 200, some 25%, as you know, Anthony, and they're highly leveraged to the health of the economy. You know, there's credit growth that feeds into the economy, capital flows are a key part of the economy, and strategically you have payments and merchant services as well, which are also very important. Banking at the moment, we've got some really big personalities. We've got Andrew Irvine at NAB, Matt Common at CBA, and he always has something provocative to say these days. And newer CEOs at Westpac and ANZ in Anthony Miller and the import, Nuno Matos. So there's certainly a lot to write about. And you mentioned Macquarie, a fascinating Australian company, one of few that has made it on an international stage from very humble beginnings, never far from controversy, as we've heard recently with their regulatory woes. But, they're always looking for the next big transformational deal, as you and I know.
Yeah, it's one of those industries where there's plenty of money up for grabs. There's always a bit of bad behaviour. So it's a great place to focus on. Now, Joyce, let's get into it. Where else to start but Donald Trump? We got some more tariff madness this week with 50% import tariffs on copper. Confirmation his reciprocal tariffs should come into play at the end of this month, while our own Prime Minister, Anthony Albanese, is off to China this weekend. Joyce, Albo should have a bit to chat about, shouldn't he?
Yeah, he certainly will, Anthony. It's a 6-day visit to China, so plenty of meetings at the highest levels, including the President Xi Jinping. Trade and tariffs and an updated free trade deal will be at the heart of what's on their agenda. But the Chinese have already sort of been saying that they're seeking to engage on AI and foreign investment rules as well. So certainly no shortage of topics there. The PM, interestingly, will also be flanked by high-profile members of the business community, including Twiggy Forrest and the BlueScope CEO, Macquarie CEO. So that should be a really big agenda over there. And just quickly, maybe explain the new copper tariffs to us and how they could impact Australia.
Yeah, it's an interesting one, Joyce. Like, obviously, we had the 50% tariffs on aluminium and steel first. Now we're talking about copper. The US is a huge copper consumer, about 1.6 million tonnes a year, 6% of the global consumption. And it looks like Trump's trying to restart the domestic copper smelting industry over there in the US. Remember, in copper, you've got to mine the stuff, then you smelt it, then you refine it. US is okay on the mining front. It's got about 70% of what it needs. But it's the smelting where it breaks down. It's only got 2 big smelters and you need to be smelting it to keep that copper production line going. So it looks like he's trying to boost that smelting industry, boost the refining industry and produce more copper that the US can use itself. It's part of his whole Make America Great Again thing, trying to fire up manufacturing, fire up industry in the US. Copper is one of those metals it's used for anything that's sort of got electrification in it, anything with a current or needs a wire, you need copper. So this is the latest metal to cop it. There's going to be more coming, if you believe analysts, zinc, nickel, lithium, all that stuff that Australia is probably just as interested in. And Joyce, something else that caught my eye this week, but unfortunately didn't catch my wallet, and that's the Bitcoin price. Did you see it hit an all-time high near US $112,000 this week? It was half that a year ago.
Yeah, Anthony, and it's gone even higher overnight. It's really been a phenomenal run in Bitcoin, and there are a range of factors underpinning it. First, we've had this sort of broad rally in risk assets, but there's also been increased interest from institutional investors, a wave of inflows from Bitcoin-focused ETFs. And on top of that, of course, we've been talking a lot about Donald Trump, the more favourable regulatory policy settings in the US, which really have stoked a lot of confidence in Bitcoin, which is the world's largest cryptocurrency. So I don't know, maybe you and I have missed the boat on that one, but certainly one to keep watching.
Yeah, it's funny. Last week we were talking about super fund returns, Joyce, and now the super funds were making 10, 11, 12% a year. And that was all because equities had had a good year, up about 15%. And then you see Bitcoin's pretty much doubled in the past year. So, it sort of puts those super fund returns into perspective.
Indeed.
All right, Joyce, it's time for our first big topic, and it's this week's WTF moment in markets. The all-new RBA policy board shocked markets, economists, and dare we say it, even Treasurer Jim Chalmers, when it kept the cash rate on hold at 3.85%. Joyce, this was one of those memorable moments in the newsroom. Like, we love a bit of drama, and, we had the big economist survey on Monday showing nearly all economists thought rates were going down. We had the markets, 95% pricing in a cut. We had our good mate Johnny Shapiro and markets editor Sarah Jones sort of hovering over their computers ready to write the story about rates being cut. And then the RBA Monetary Policy Board kept rates on hold. Joyce, what happened? Like, how did this board go from considering a 50 basis point cut at the prior meeting to not cutting at all this week?
Yeah, it was quite dramatic or an anticlimax, whichever way you'd like to say it. Certainly we were all expecting it. It all really hinged on the board wanting to wait for more detailed information on inflation and more evidence of a sustained decline. The statement from the Monetary Policy Board on Tuesday was really clear in saying that they wanted a little more information to confirm that inflation remained on track to reach 2.5% annually on a sustainable basis. And, we do have the ABS quarterly inflation data out on July 30, and that will provide a much fuller picture on how the economy is faring. Michelle Bullock, she said that they really needed to make sure that they'd nailed inflation. And she was unequivocal that the direction was going to be lower and down, but, it is this sort of cautious approach that the RBA is taking from here. But yeah, it did cause consternation this week for sure.
Oh, yeah, it was genuine shock. Like, the market moved straight away. It was one of those ones where you had to read the statement a couple of times just to make sure you understood it right. No doubt about it. But I thought once Michelle Bullock started talking in that press conference, she must have said 10 times that the trajectory of rates is still the same. It's still going down. It's just the board wants a little bit more time. And like you say, they've got another meeting coming up next month. It's funny because we've changed the cycle of the meetings to 8 times a year from monthly, but just the way they line up, we've got one in July, one in August, one in September. So we've got this rare sort of occurrence where we've got 3 meetings in, basically 12 weeks. So the RBA's got time on its side. It can just sit back, let the data roll in, and it's funny because when we've seen cuts as well so far this year, it's come straight after that quarterly inflation data. Like when the board met in February, they had the December quarter data just fresh out. When they cut in May, they had the March quarter data fresh out. Next one, they'll have the June quarter data fresh out. So
yeah, it seems to make a lot of sense. And she did sort of hint that, the monthly reads weren't as reliable. So I think the RBA really wants to ensure that those monthly reads are giving them a good indication before they sort of take them at face value. And the quarterly data was so close to coming out anyway that they thought, what's a few more weeks going to matter?
Yeah, she pointed to 2 things from the monthly reads: home building costs and durable goods costs, which are things like furniture and computer equipment. So it's funny, those monthly numbers do bounce around. Yeah, then she also says, but we're watching them and we're worried about these couple of things.
And Anthony, we did get served up a bit of a treat on Tuesday despite the sort of anticlimax. The board disclosed that it was a split decision, 6 votes for holding and 3 against. And was that the first time we've seen a split decision and the RBA disclosing it?
Yeah, it is. And it's good. It's healthy. You know, not everyone has to agree on everything all the time. And from the outside in, this one was contentious, right? Just look at what the market thought versus what happened. And then, so why not show that internally it was contested as well? And Treasurer Jim Chalmers, I mean, he said it was good development. You know, the fact it was a split vote, that probably helps him. He's very keen to see rates go down because that's what the ordinary punters on the street that vote for him and his government, that's what they want to see. And remember, it's only 2 years since we got the big RBA review. They only put this monetary policy board together and implemented it at the start of this year. So if you shake things up, of course you're going to get a bit of a shake up in results and the way they're going. But as soon as you see a 6-3 split, I mean, you can't help but just try and guess who's on the 6 and who's on the 3, right?
Yeah, and we have had that this week, right?
It's been the market's favourite game this week. And, you know, I'll defer to John Kehoe, our economics editor down in Canberra, and Johnny Shapiro, our mate up here in Sydney. You know, they looked into it and they said that 2 of the Labor appointees almost certainly were the ones that voted for the rate cuts. So they were part of the 3. That's Jenny Wilkinson, the new Treasury Secretary, at her first board meeting, no less, and Ian Ross, a former Fair Work Commission president. So they think that those 2 were in that 3 camp. Obviously, Michelle Bullock got asked about it and she didn't want to disclose how any of the directors voted, including herself. And I can understand that. But I mean, I think it's pretty safe to assume that Michelle Bullock, that her number 2, Andrew Hauser, the RBA's 2 representatives, they were on the 6 side. They were on the rates on hold side.
Pretty safe assumption.
Yeah. But what do you think of the disclosure?
Yeah, I mean, it is very interesting, but I suppose it is indicative of what the Independent Monetary Board and that sort of composition are supposed to bring a bit of dissent and a bit of argy-bargy, if you like, around what they should or shouldn't be doing. So I think that's really healthy. But yeah, that sort of disclosure of the numbers over the representatives does spur a lot more inquisitiveness around who voted which way. So it's really interesting. I suppose they don't want the dissenters to get singled out in the media, I would assume.
Yeah.
And the economists mostly got it wrong. We had our survey out on Monday and, you know, I think it was 4 or 5 that were a very small group that were saying they expected the RBA to hold. We shouldn't be too critical, I suppose. None of us have a crystal ball and we thought they'd cut as well. What did that sort of mean for their rate cut predictions post-meeting and what are they saying for the rest of the year?
Oh, God bless them, Joyce. They barely changed. Look, this meeting's not great for the economists, right? I mean, these people paid pretty good money to come up with predictions, but I think the more the Bullock spoke, the more she comforted them, right? She said that rates were trending down as they expect, just not yet. She said, wait for the next data. These economists love their data. She talked about uncertainty and volatility. All of that feeds into what the economists are thinking and what they've been saying. So the commentary out of the Economist was actually very similar to what it was going into the meeting. It was just, you know, what we've been saying, it's going to be 4 weeks, 6 weeks later than what we tipped. So, you know, HSBC's Paul Bloxham literally said, you know, RBA is still going to deliver 2 more 25 basis points cuts, 1 in the third quarter, 1 in the fourth quarter, just as I previously expected. It's just the third quarter one's running a bit late. JP Morgan's Ben Jarman, pretty much the same thing. Nomura's Andrew Tricer, same thing. I mean, you could go through all those market economists and, you know, they're all saying that the rate cuts are still coming. It's just they're happening a little bit later. Joyce, we can't keep you away from the banks, though. I mean, the RBA cuts rates, and you're thinking about what it means for the banks, for the big 4 banks, for their earnings and their profits. Tell us, what does it mean? Is this good or bad for our banks, and is it good or bad for their customers?
Well, basically, the fact that the RBA held rates steady does provide some short-term relief for banks in terms of the pressure on their net interest margins, a key measure of profitability for the banks. Mm-hmm. You know, that's one factor. Obviously, bank bill swap rates, funding markets also feed into their pricing. So there will be some short-term relief there. I mean, if it is only a matter of 4 or 5 weeks, you know, that will sort of filter through later in the year. But, you know, that does, analysts will be closely sort of monitoring that. From a customer perspective, we do know that mortgagees were wanting another cut in rates, despite the fact that not that many of them actually requested the banks reduce their repayments the first 2 times. But what we kind of have to start to think about now is that the banks do have a terrible record of passing on rate cuts in full. I got CanStar to cut some data on this to look at the last decade. And, you know, CBA, ANZ and NAB have only passed on 6 of the last 12 RBA rate cuts.
Really?
Yeah, in full since 2015. Westpac, it's even worse. They've passed on 4 reductions in their entirety. They did pass on one of those at 28 basis points as opposed to 25. But that really shows you that at some point in this easing cycle, the banks are going to start sort of pulling back on passing the rate cuts on. We've been through the election cycle. Perhaps the pressure's come off a little bit. They've got shareholders to answer to. So that'll be something interesting for the months ahead, Ant.
Okay, and just lastly, Joyce, pretend you're an economist. Get the crystal ball out. What are rates going to be at the end of the year? They're 3.85% now.
Well, I say it'd be, definitely low threes. There will be more of a slowing in the economy. How pronounced that is anyone's guess, but, consumption is still volatile. Consumers do sort of seem to be dipping their toe back in on the spending side, and that might improve a little bit in the lead up to, Black Friday and Christmas. But I think certainly, as Michelle Bullock said, the direction is down. It's just a matter of timing, and definitely 1 or 2 more this year.
All right, I'm on one more cut, 3.6%. I think the jobs market's still very strong, as it has been, for a few years now, post-COVID pandemic. Yeah, I'm going to tip that maybe the economists are going to get it wrong again. All right, Joyce, let's go to our second topic, and this is where we make you really sing for your supper. You're our number one Macquarie watcher. I'd argue Macquarie is the number one company worth watching for what we do in Australia. Let's pick your brain a little bit, and we'll start with a bit of the news. This week, we had news that Macquarie is not only thinking about dumping PwC as its auditor after more than 30 years, but it has a couple of PwC's rivals, EY and KPMG, in a head-to-head battle to replace the poor old firm. What's going on here, Joyce? Do you think this is more a fallout from PwC and the tax issues, or is Macquarie thinking something else?
Yeah, it's really interesting, Anne. Now, PwC have been there since 1993 as an auditor for Macquarie. Now, that's even before Macquarie listed on the ASX. So it's an extremely long time. There are a couple of factors here at play, including the tax advisory scandal, which hit PwC to its core, and that, did lead a number of large ASX companies to reassess their audit relationship with PwC, including Westpac, which actually replaced PwC as its auditor. But it also does come down to just good corporate governance to change auditor, not just the individual doing the audit, but the firm. Macquarie did review the PwC relationship last year as well in the wake of the tax scandal, but chose to stick with PwC, because they've got such sprawling global operations and such a complicated business. You've got a non-operating holding company structure and a bank as well. Can kind of understand there being a long-standing relationship here, but, when we're talking about over 30 years, that's much longer than most. So this time round, it looks like the lucrative audit for Macquarie is headed elsewhere. There will be a period of transition, though. With these big audits, it doesn't just happen immediately. So it might not be a 2026 thing. It'll be something that happens in 27 for Macquarie's financial year 27. And Macquarie have also agreed to tender for audit every 10 years now with a comprehensive review.
Every 10 years?
Yeah, midway through. So,
what a good contract, 10-year contract.
So, there's sort of quite a concession here, if you like, from Macquarie sort of saying, well, yeah, we probably do need to look at this more frequently. And there's also been an issue here with Michelle Hinchcliffe, a Macquarie board member, and Edmund Tadros, the professional services editor at the AFR, and I called it out in the piece this week. She's ex-KPMG, a very long-standing career at the firm, including as head of audit at KPMG in the UK and head of financial services at KPMG. And Macquarie were a bit cryptic. They wouldn't really answer the question about whether she'd recused herself from these deliberations. So it's a bit of a worry, I suppose, because there are conflicts of interest here and perceived conflicts of interest. And you'd really want to hope that, they're doing this after such a long time, that it's a process that's properly managed and run to come out with the best possible outcome. And you actually worked in that PwC audit group in Sydney, that looked after Macquarie. So you've got some inside knowledge here. On a scale of really, really bad to downright disastrous, what would losing the audit mean for PwC?
Oh, it's a shocker, Joyce. Like, such a big, sticky client. I mean, the best thing about Macquarie, like you say, it's prestigious, the big sprawling global network, more than $1 billion in fees that they've collected over the years. Like, it's a huge job. But the best thing about it is it's a March year end. And it's actually the biggest company in Australia with a March year end. So if you're an audit firm, it means that you've got all these auditors who are mostly young sort of uni grads and people getting their CAs. They're sitting around with not much to do at that time of year. So you got the Macquarie job. So you basically just shift everyone over onto the Macquarie job, and it keeps everyone really busy for that March year end and then the September half year. So it's a huge job in there at PwC. They always had one of the top partners in that financial services audit division on the Macquarie account, as you'd expect. You wouldn't like to be one of the people responsible for losing it, but let's be honest, Joyce, they had a bloody good run.
They did. They did.
All right, Joyce, the next step in the Macquarie calendar is the AGM. It's on July 24. Sometimes we get a trading update at the AGM. How do you think this financial year is shaping up for Macquarie? Do you think it's better or worse or relatively unchanged from the past few years?
Well, Macquarie's always a difficult one. There will be a first quarter update from Macquarie for the June quarter. And we know that their results can be very lumpy if they book some asset sales or benefit from volatility in commodities markets. So, you know, this year I think analysts are sort of saying it's going to be a better year, but not a stellar year for Macquarie. You know, we're still sort of seeing the performance fees and things coming through from the massive air trunk transaction of last year, which was, you know, the marquee deal of last year in the, you know, $24 billion mark. But it's relatively early in Macquarie's financial year, which ends on, as you said, March 31. So it's hard to be too definitive at this stage because, you know, they do have a number of moving pieces and, you know, we're seeing currencies move, we're seeing commodity movements in commodity markets. Volatility can be good for Macquarie in some parts of its business, but, you know, on the advisory side, deal advisory side, volatility can actually impede and hinder deals. So, yeah, it's really hard to sort of say this early on in their year.
Okay, so but just take a step back for a minute. How do you think Macquarie's going under Shamara Wickramanyaka's term as CEO? I mean, this bank, it's got a great tradition of twisting and turning its business model to make the most of whatever opportunities it can find. Do you think that she's got it focused on the right areas?
Well, she does seem a little bit more risk averse, I think, compared to Nicholas Moore. And that could be just also a function of the pandemic sort of hitting a little over 12 months into her tenure. But as we know with Macquarie, they're not afraid to kind of shift focus, change direction. We're seeing that now with Shamara in selling of the public markets business in the US. Mm-hmm. That was a marquee deal for them in 2009. Yep. She's basically saying the kind of returns that she had expected and that they were seeing in that business are not there now, and that private markets are, in fact, more attractive from a return on equity perspective. Now, I think you could probably say that Macquarie haven't perhaps capitalised on the private markets, private credit opportunity as much as some of the other banks. You've seen big global players like JP Morgan really push directly into private credit in partnership with other firms, but perhaps selling the public markets business gives them more scope. And she did say that when they announced that they wanted to push harder into private markets where there were better returns. What we know about Macquarie is that there are 4 distinct divisions. I'll just very briefly take you through them. Asset management being, you know, managing listed and unlisted assets. Mm-hmm. There are there's a stable of infrastructure and other private investment funds, which they've been raising for, you know, more than 20 years now. Commodities and global markets. There's trading, risk management and financing. Across that business. It's a big powerhouse for Macquarie, particularly of the last few years. That also houses their equities business. Macquarie Capital is the advisory business, you know, where they work on M&A and ECM deals. Don't need to tell you that. And also principal transactions from Macquarie's balance sheet. They've always got, more than a couple of things actually on the go. And banking and financial services, which has turned out to be a nice little earner for them. Greg Ward runs that division. It's home loans, business loans, their platform business and the private bank.
Mm-hmm.
So, it's going to be an interesting time ahead for Macquarie. It'd be interesting to see how they pivot following the sale of that public markets business.
Yeah, so a big thing Macquarie's done in the past decade, it really got into this sort of energy transition, investing in renewable energy and everything, starting over in Europe, and then sort of taking that model over to the US. Now, obviously, Donald Trump has landed in the US. He's trying to roll back some of that stuff. There's at least more volatility around its energy transition over there. Do you think that's going to be a net positive or a net negative for Macquarie and what it's trying to achieve, particularly in the US?
Well, I actually think it's a net positive for Macquarie, funnily enough. And, Macquarie were pretty quick to jump on the bandwagon and exit the net zero banking alliance when, you saw the likes of Goldman and others doing the same, that big sort of group of banks doing that. Macquarie do sort of talk up their green credentials all the time. They are big in renewables, but it's still only a relatively small part of their earnings. The commodities business, which is more the traditional commodities and, risk management financing, is the engine room of Macquarie and has been for some time now. So it could be quite beneficial to Macquarie, the sorts of things that Donald Trump is bringing in. The only thing I would counter that with is that, there had been some talk about rolling back the Inflation Reduction Act by Donald Trump. And as long as the US states don't rescind funds that have already been allocated under that particular legislation, that Macquarie would benefit from an infrastructure and renewable energy perspective, and that would be really difficult because the funds have already been allocated, by the way. Then if that doesn't happen, I think Macquarie is a net beneficiary here.
All right, Joyce, it's time for a quick break. We'll be back to look at what's on next week and take what I would say is the question of 2025. We'll catch you after the break. Okay, welcome back. Joyce, there's plenty on again next week. It's US earnings season, really steps up. We've got all the investment banks, JP Morgan, Citi, Bank of America, Morgan Stanley, Goldman Sachs. June quarter results will be out. They always provide something to look at, don't they, Joyce?
Yeah, indeed. Especially, as you said, with Macquarie's AGM coming up as well. Always keep an eye on what the big globals are doing.
Yeah, and on Tuesday night, our time, we have US inflation data. I mean, this one's interesting because we've got the next Federal Reserve meeting the end of July. We got minutes from the June meeting actually this week. It seemed to confirm the FOMC was in no rush to adjust rates. A bit like Bullock here, actually. Participants over there, they think the rates are mildly restrictive, no great rush. They're probably further along the rate cuts path than we are. We tend to lag them by 6 months. So it seems like they could be on hold for a bit. And then finally, Joyce, on Thursday, we have Australian unemployment data. And this is the other thing that came out a bit in the RBA press conference, wasn't it? That, they're really back talking about this dual mandate of inflation and jobs again.
Yeah, that's right. The labour market was mentioned by Bullock quite a few times on Tuesday as she sort of walked through the RBA's rationale for holding. And the labour market, as you said, is still very strong and robust.
All right, if you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Joyce, we love questions here on the Chanticleer podcast. If you want to send in a question, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from and email us, or use the toggle on Chanticleer columns on that website. This week, Joyce, we have a question from Anthony Parle from New South Wales, who wrote in via the website, and he asks, do you think at the end of Trump's term, the US economy will be better or worse than it is today? A friend of mine said to me, I have an economics degree, so I know tariffs will destroy the US economy, inflation, unemployment, and reduce GDP. Is there a bigger picture that we are all missing? Joyce, this is really the question that we're all thinking about this year, isn't it? Like, is what Donald Trump's doing over in the US, is it working? Is it not working?
Certainly.
Is there a plan to it all? Is there not? Is the US going to be better off, worse off? What do you think?
Well, the thing is, we all know that tariffs are essentially a tax, and domestic consumers will be left paying higher prices, which can affect consumption. So there is a real risk here, in my view, Anthony, that the economy does suffer, the US economy. Tariffs are also really inefficient because they allow, less competitive domestic companies to operate in a quasi-protected way. So, this could be damaging for the US economy. That's obviously not Donald Trump's intention. He wants to bring down debt and stimulate industries, as you said, copper previously in terms of domestic production. But what we are seeing is Donald Trump sort of coming out and saying various things around tariffs and then stepping back. So we have to see where this all lands, basically, before we can really understand the longer-term impacts to the US economy.
Yeah, I'd say Anthony from New South Wales, if we learnt one thing this week, it's be careful listening to economists. Look, what Trump's doing is disruptive. There's so much bulldust about it, so much chopping and changing, so much drama, attention. I hate watching a lot of it. Yet you also can't take your eyes off it. But Your economist friend is right, I think, Anthony. Like, history shows us tariffs are not the answer. They are not the way to build globally competitive industry in a global economy that's established. But Trump doesn't care. He's been a long-time tariff proponent. And if you look at the US balance sheet, social issues, what it's like outside the big cities, why Trump got voted in, people want change, and Trump's willing to try and jam it through. For all the noise, though, the supposedly life-changing moments, in rose gardens and the speeches and all that stuff from Trump, US is the number one economy in the world, and I think it will be at the end of Trump's term, right? The whole Western world wants and needs what the US is making: tech, software, NVIDIA's chips, Apple's iPhones, Microsoft, Salesforce, whatever, that's why you can charge tariffs and get away with it. That's why people will do trade deals with them. And the alternative to it is the Chinese products and Chinese providers and their security concerns over them now. And I think there will be in 10 years' time, 20 years' time, 30 years' time. So I think the US has got quite a healthy moat around it. And Trump, whatever he's going to do, isn't going to stuff that up.
Yeah, and I suppose Australia, we're also watching how the Chinese economy fares through all of this as well, Ant. So you made some really good points around security concerns there. So this week, Albanese doesn't really want to talk too much about AI with China, trying to keep it out of the free trade agreement. So, interesting times.
Well, Joyce, that's the show for another week. It's been great having you on. It's fantastic having you back at the AFR. I think you've shown us today it is where you belong. Congratulations on your Chanticleer podcast debut, and thanks for being a part of it.
Thanks, Ant. Appreciate it.
If you like the podcast and want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, Anthony MacDonald, and Joyce Milakis. It was produced by Alex Gow and Mandy Coolin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.